most CPAs recommend, and that's kind of my rule of thought too, is like once you start making like $50,000 in income, it's good to change your entity type so that you don't have to pay those self-employment taxes. So that's a good one, is knowing what your numbers are so that you can maximize your entity structure. So you may need to go from an LLC to an S Corp, or from an LLC to a corporation, just kind of knowing which direction to go in order to reduce your taxes. The other thing is charitable contributions. It's high now, you give money now and you get the tax deduction. There's also ways you can do like a defined contribution plan. I think it's a defined contribution. I have to verify that one, but you can put the money in now and then you can tell them where it goes, so that you get the tax deduction now, but they can give it to them kind of later. So that's another thing to think about. So like, sometimes people have a lot of income in this year, but they may not have enough the next year. But you can't make those decisions if you're not sitting down and looking at your numbers.
Over 50% of Black Americans are unmarried, and only 2% of Black families in America have a net worth over $1 million.
We are on our journey to not only join that 2%, but grow that 2%.
Facts. I'm Devon Travell, creator of Black Wall Street, the board game, with my beautiful co-host.
I'm Sinclair, aka the Health Nerd. You can go to our website at them4show.com, our Instagram at them4show, and our YouTube channel at Melanated Married Millionaires in the Making.
And welcome to the M4 Show.
So tax planning and strategies, okay? So we've kind of talked about some strategies, but let's go on to the next slide. Be proactive. That's a big thing. We want to, again, now is the time to be working on 2022 tax planning, not in January. You can't do anything in January. And let me just write something else. That relates to anything, buying stock, selling property, buying property, all of those things, you can't do anything about it after in 2023. It has to do it now in 2022. So you have to know your income and deductions, whether you're an individual or a business owner. I say wage W-2 earner. Maximize retirement. That's a good way to be proactive with tax savings. Maximize entity structure. So we've been talking a lot about a sole proprietor and single member LLC, and I did mention about the self-employment tax, right? And like if you're making $100,000 net income, you're going to pay at least $15,000 in self-employment tax, right? But most CPAs recommend, and that's kind of my rule of thought too, is like once you start making like $50,000 in income, it's good to change your entity type so that you don't have to pay those self-employment taxes. So that's a good one, is knowing what your numbers are so that you can maximize your entity structure. So you may need to go from an LLC to an S Corp, or from an LLC to a corporation, just kind of knowing which direction to go in order to reduce your taxes. The other thing is charitable contributions. It's high now, you give money now and you get the tax deduction. There's also ways you can do like a defined contribution plan. I think it's a defined contribution. I have to verify that one, but you can put the money in now and then you can tell them where it goes, so that you get the tax deduction now, but they can give it to them kind of later. So that's another thing to think about. So like, sometimes people have a lot of income in this year, but they may not have enough the next year. But you can't make those decisions if you're not sitting down and looking at your numbers. So even with charitable contributions, when it comes to W-2 earners, again, I said, you may want to, it may come to the end of the year. It's like, oh, I could give this, $3,000 or $5,000, whatever, in December, or I can give it in January. Which one is going to be more beneficial for me when it comes to my taxes? Even making it extra tax payment or a mortgage payment. It's like, those are all things that you need to look at. So because it may benefit you. It's like you may make an extra mortgage payment on the 31st of December, and that takes you into a higher, takes your deductions higher compared to if you wait until till January in order to pay it. So those are all things that you do with tax planning. Also, it may be kind of like timing for income and deductions, paying expenses ahead of time, so that you get the deduction in this year, or waiting to pay a bill the next year because it's not going to make a difference. You have bigger loss this year, you may have more income next year. But all of those are things that come with tracking and being intentional about knowing your numbers and paying attention to it. So let's see, what if I only anticipate making the amount to change my interest structure for this year? What are we worth changing? It depends. So if you change your entity structure, like if you go from a sole proprietor, or if you elect S Corp status, you have to stay there like 5 years. I think you have to stay there like 5 years, or either if you go there, you can't change. But you can't just go back and forth. So that would be a matter of seeing what it would make difference for you for this year. Did that make sense? Was that clear? But you can't just say, okay, I'm going to be at LLC this year, but then I'm going to be at S Corp next year. No, it's like once you make the election, you're there. And then like if you change it back, I think you may have to wait 5 years. There's a 5-year period, and I will get that exact understanding of it, but it's a 5-year period. Either you have to stay that way for 5 years, or you can't change back if you change back for 5 years. So so that's good to know. And that's something that you would want to sit down and talk to your CPA about. Okay, so we go to the next one. So maximize deductions. We talked about travel. Another deduction that is big. You guys hear the G-Wagon, right? Everybody wants a G-Wagon because they want to maximize their deductions. And that has to do with the Section 179 and the bonus depreciation, which is changing as of the end of this year. But keep in mind that buying a G-Wagon, it's good, but you want to make sure that you have the income, and you also want to make sure that you have the business purpose for it. So every tax strategy, every situation doesn't apply to everyone. So you need to know what applies to you and have those conversations. But, it all starts with knowing your numbers. So that's another strategy. The other one is hire your children, right? You can hire your children to work in the business for you. You can pay them up to about $12,000, maybe a little bit more. It's based on the standard deduction. And they end up not having to pay tax on that because it's under the standard deduction amount, because they would have to file a tax return. And then the business will get a deduction from it. So that's advantageous if you have a child that's going to work as an employee. So keep in mind that you're hiring your children. They're an employee. You can't just say that they're going to work for you, or that you just give them money. You need to document that. And again, I say the IRS is starting to look at all these things. So make sure that you have your ducks in a row. So if you're hiring your children, make sure that you have to pay them a paycheck. They have to be on payroll. They have to have a job description. They have to actually report to work, and you pay them into their account. So you want them to actually be an employee. But there are a lot of benefits to hiring your children, but you want to, again, make sure that they are actually an employee. Another one is the Augusta rule, which means that you can rent out your home for up to 14 days and not have to report the income. So say, for instance, you want to rent your home for business, right? You would set it up, sign a rental agreement, pay from your business, pay to yourself, but you can only do a maximum of 14 days. And then you as an individual don't have to report that income on your tax return. So that's a good one. Again, I have to keep saying that all of these different things, they are unique to each individual. So make sure that you speak with your tax professional. Accountable plans is a big one for corporations and S corporations. And those are where you can reimburse for expenses, and the individual doesn't have to pay for it. So for instance, like we were talking about the business use of home, if you're an S corporation shareholder and you're an employee and the S corporation has an accountable plan, you can actually submit a reimbursement every month for, for renting a portion of your home, for your portion of the cell phone bill, for mileage, right? Again, think employer. And then the employer reimburses you for it. It's a tax deduction for the employer, and then it's tax-free income for you. And that's for S corporations. A lot of people forget about that, but that one's huge. It can account to a lot of money. And like I said, it's tax-free money for the individual, and it's a deduction. It's a business deduction for the business. Talking about, so wills and trusts and step-up and basis, those go to generational wealth. And before I go in there, I just wanted to check in with Sinclair and Devon, see if they had any questions.
It's like you were in our brain.
We were percolating over here. Oh my goodness. So where to start? Let's start with the Augusta rule.
Okay, yeah. We've been talking about that.
We've been talking about the Augusta rule because we've never heard of it. And so Queen, I don't know if you had a particular question, but one, I just want to kind of re-go over it again to make sure I heard it correctly. And then we got some follow-ups.
So my first question was on the timeline. You said you can rent it out rent out your house for up to 14 days without having to report that income. That's a 14-day period within a year, or what's the time frame?
It's within a year.
Okay.
So yeah.
And
per
then
year, without needing to report the rental income. I did something. There we go. Okay.
Does it matter what you're renting it out for? Like, can I say your idea?
Yeah, go. You know what? So first off, everyone listening, we're about to give you, if it's applicable, $1 million play over the next 10 years. $1 million play right here. This is our idea that we just came up with based on just the little knowledge we have, and we're gonna see if Marjorie's gonna shoot it down or praise it up. Go ahead, Queen.
Like, let's say you have a larger estate or like a big backyard or something like that where you can host events like a wedding that costs thousands of dollars. You're saying 14 days. I mean, a wedding typically is only 1 day, maybe 2 days that somebody would be renting it out. So like, are there stipulations on what it could be rented out for? Because I'm thinking hosting 14 weddings in a year of, weddings can cost anywhere for like $20,000 or something like that. Pay for itself. I'm just percolating up here.
There aren't any stipulations as far as how much it can be for. So like during events, Super Bowl, the Augusta rule came about because of a golf tournament, right? There were people in Augusta, there was a golf tournament, and they would rent out their home for this tournament. And so they were able to, because it was, under the 14 days, to not include that income. So you could have something there.
Listen, this is why it's so important to learn about these things, because the Augusta rule came about because I'm assuming this was a very wealthy family that was hosting a golf tournament, and they were just like, you know what, we're having all this income, we don't want to do the taxes. Cool, beautiful. But now that family changed the tax code. But it's not
just the one person. It was like they would have this golf tournament, so there were people in the area that would rent out their home. So
got you. The whole community.
When is the Olympics about to be in LA?
That's a great point. So the Olympics is coming in 2028, right? There's going to be thousands, if not millions, of people that are pouring into LA, Southern California. So if you own a home and you're in the opportunity where you can maybe remove some of your personal stuff and host events, that's going to be a amazing time to listen. We got to run the play, y'all. Y'all got to run the play. If you didn't learn anything else this whole week, run this play.
Just know these are the types of conversations we be having at dinner.
Literally, we'll have this. Oh my!
Like, what if we could? Oh my gosh! What if we?
So we need to make sure we get a nice little something by then. Okay, That's
Okay.
Yes,
the rule.
make sure you get a nice little something like there. My CPA friend said it was the Masters tournament. That was
Okay,
that
yeah.
totally makes sense.
It does.
Look, and it's just crazy. I'm sorry, I do not want to take us on a tangent, but it is crazy how laws and regulations and things get changed for certain communities.
Certain
And
communities.
this is why it's important to know
get
them, right? This is the first
information.
time maybe a lot of you are hearing about this and how you can now take advantage of it
And you can now
because
take
they've taken
advantage of
advantage of it. And this is how people are getting the leg up.
Literally.
You
Yes.
gotta know the play, run the play.
Run the play. If you have a house in LA, run the play. Run the play.
Hey, listen, I'm gonna talk to my auntie. She got a house right there in Inglewood. It's prime location.
And even in the IE, folks have, I mean, there are pockets in the Inland Empire where you can get properties with a lot of land for really inexpensive. And I mean, people who, anywhere there's people who are living are gonna need places to rent out for weddings, for quinceañeras, for different things, right? You can definitely have this be a little side hustle. This is great.
Right,
Wow.
that was good. I have more questions, Quinn. We put up the.
Okay, my bad. My
Yeah,
bad.
I'm sorry. Look, we're gonna get right back into the amazing podcast. But if you didn't know, in 2017, we created Black Wall Street, the board game, because we thought more families needed to know about the history of Tulsa Black Wall Street. More families needed to know about the legacy of Black excellence left behind of Tulsa Black Wall Street, that we can own a Madam C.J. Walker Beauty Salon. We can have a Booker T. Washington High School. We can have an Uncle Steve's Barbecue. We can have a Renaissance man like Simon Berry, who had his own taxi service and bus service that got bought out by the city of Tulsa. We have brilliance in our DNA. We wanted to make sure that your family can play a game that teaches them about this brilliance. So we have Black Wall Street, the board game, right here. We had the first edition available in 2017. That got sold out. We're on the second edition right now, or you can get the beautiful masterpiece version of the game as well. It's up to you. Head to playblackwallstreet.com and get yourself Black Wall Street, the board game, to empower you, your family, and generations to come. Playblackwallstreet.com. Let's get back to the episode. So real quick, you said that the 6,000 pound rule of the G-Wagon wool is going to possibly be changing by the end of this year. Do you know what
this year it changes? So if it changes, it's going to be like December 31st.
Okay. And do you know what it's updating to, or is it's just being completely deactivated?
It's not going to be completely deactivated. It's probably going to go back to probably like 50%. No, so let me take that back. So the bonus depreciation, which is now at 100%, it used to be like at 50. So I'm not exactly sure what it's changing to. What happens with the Section 179 is that it used to be at like, I want to say like $250,000 max, and I think it's more like at the millions. Yeah, but I don't have those exact numbers, but it is changing the end of the year.
Okay. And kind of a follow-up to that, and then I have one separate question. That's changing, but you can still, if you're using your car for normal and appropriate business use, you can still write off the mileage, or maybe if you're leasing a car through your business, can you deduct that lease payment? So like what are the alternatives if the car doesn't weigh 6,000 pounds?
You can. It depends on, so a couple things. The business usage for the vehicle, right? And like we talked about business mileage. So you can deduct either actual expenses or or the mileage. But so the actual expenses are going to be based on like the percentage that you use the vehicle for, right? The mileage, you usually get to deduct the mileage. I didn't say that right. So it's either or, right? Most people end up, the mileage usually ends up being more than what the actual expenses are, because the actual expenses are going to be based on the percentage that you use the vehicle for, right? So say, for instance, your lease expense is $6,000 for the year, but you only use it like 10% based on the proration of the total miles to the business miles, right? So you only get to deduct $600, but your mileage could be, more based on the cents per mile amount. So it's the higher of the two. But I think it's important because a lot of people say like a lease payment, but it's based on the percentage that you use your vehicle in the business, right? And it should be legitimate business use. I kind of think of it like I have a client that does trees, you know, and so they have these big trucks that they use to go and cut down trees, right? That's a business. That's more like equipment, but that's like a business vehicle. You know, it's like, so you have to look at it. It's like, do you really have a vehicle that's used 100% or more than 50% for the business, not just commuting, but actually for the business, you know? An Uber driver, you know, they use their vehicle a lot for business. You know, you could have a delivery company. You could, you know,
you know, we're thinking over here. You know, we're thinking. Okay.
You know, something like that. But you want to use it for your business.
Yeah.
Not just have it.
Okay.
Not just say that it's for business, but you want to use it for your business.
And not just the commute. Okay.
And not the commute, not because the commute doesn't count. It's like we don't get to commute. We don't get to deduct our commute, right? You know, when I was commuting, you know, 1.5 hours to work every day, it's like nobody paid me. You know, I didn't get to deduct my gas.
So I did get to deduct. So if I was going on like a recruitment trip, I'm going to a high school, I'm going to a college, I got to deduct those miles. If I was going to a site, right? So if we have sites, which we do, we have sites where we have high schools and we have colleges around where we drive to on a weekly basis to get to these places and to teach classes. Even that vehicle, we would just do the mileage. It wouldn't be if I have a vehicle where I only do site visits with this car.
I think if you had a vehicle that you only did site visits with, right? And so you only use it for business, you never use it for personal, then yes, that would be 100% business vehicle.
Noted. Okay, noted. Yeah. Last question for you. Last one, because I know we're over time. Appreciate you. Literally, you've given $1 million worth of gems in this. It's been really good. Well, you talked about being able to hire your kids. And, you know, as we talked before the session, we don't have kids yet, but we really want them. They're going to be around and they're going to be working in the business, Miss Marjorie. Look, listen, they're going to be working. So if we pay them the wage, can we still also take the standard child deduction, or do you have to pick one?
Well, you can. And just think of it as like your child goes out and they get a job working at McDonald's or Starbucks or something like that. Instead of them working for Starbucks, they're working for the M4 show.
Yes,
right?
ma'am.
And so you just pay them as an employee. You can still claim them as a dependent because you provide over 50% of the support for them, but they also have earned income and they just need to file that return, and they need to note on the return that they're paid as they're claimed as a dependent on someone else's return.
Listen, that's a huge unlock, because I know as a kid, no disrespect to my parents, but if I wanted to go to the movies, I had to find out a way that I can earn some money to go to the movies. If I wanted to go to Six Flags, if I wanted to get some new shoes, I had to buy all those extra stuff. They paid for my beautiful, amazing life. But if I wanted extra social stuff, I needed to get a job working at McDonald's, working on a farm to pay for those things. But in this model, right, your kids can work for your business for the extra stuff.
For the extra stuff.
Yeah, I love that. Our kids would definitely
and hire them as employees and make sure that you have job descriptions, age appropriate duties. They're employees on payroll. They have a W-4. They have a bank account where it's going into, you know, run it like a business. You know, they're an employee. Age appropriate. My granddaughter is 11 and
she's already
working.
Love it.
You're gonna learn how to do some taxes around here.
Listen, the youngest CPA in the world right there. 12 years old, letting you know. Thank you for supporting the M4 show and our mission to increase the wealth of Black families.
If you received any value from this episode, any value at all, any, do us a favor and give us a like and subscribe on YouTube and Apple, Spotify, anything, all of them, all of them. Wherever you're listening, go ahead and like and subscribe.
And after you like and subscribe, make sure you send this episode to at least one family that you really want to see win. We'll catch y'all next time. Peace.